Well, welcome everybody. My name is Eric Rice. I'm the Chief Growth Officer here at King Operating. Thank you for coming this evening. The purpose of tonight is to run through kind of a macro perspective of where we are economically around the world, things that are happening right now, how oil and gas fits into that, and then some of the basics of understanding how to invest in oil and gas. There's really about 4 ways. I'm going to go through that. To give you a good agenda or layout as to where we are, I'm going to stop in 1 hour, maybe a little bit earlier than that. But I plan on doing about 20-minute overview of the general economics, factual information that you should know and understand so that you can better prepare for the future, so that you can be more informed as an investor. Even just talking to other people, it's important to know the information that's happening economically because economics affect us all. So I'm going to do about 20 to 25 minutes on understanding the environment that we are in right now, from the stock market, bond market, currencies, so on and so forth. Then I'm going to do a little bit of a breakdown of how you can invest in oil and gas the different ways. And then I'll do a very brief 1 or 2 minutes explaining what makes King Operating different from other investments out there in the market. And then I'll take maybe 15 to 20 questions. So don't fire them away. I'm sure I'll cover a lot of the things that you're asking as we move forward. But as we get near the end, feel free to put questions in the Q&A section and I'll answer as many as I possibly can within the hour. But again, the purpose is educational. It's quick hit, very fast information. Stuff that you can use to make better and more informed decisions for you and your family for investing or just making basic expenditure decisions in the home. So let's get started. Well, number one, thank you so much for coming today. I'm going to give you 2 words before we begin here that I think every person should have on the top of their mind while I walk through world economics. Number one, there's the word prepare. And the other one is scare. They both rhyme, and I'm not Dr. Seuss, but if you put those 2 together, it's better to be prepared than scared. And to be honest with you, when I run through factual information that's happening in the market right now, it may scare some of you, but these are events that kind of have to happen along the course of history in order for an economy to fully rebound. And I will go through some historical data for you and things like that. I'll be happy to expand on any of the information I'm giving to you in the Q&A. And I'll keep it as brief as I humanly can. I'm generally a very concise speaker and I speak very quickly. So if you have any questions at the end of this, feel free to put in questions in the Q&A. If you're interested, and I won't go too much into what we're doing in our deal here. But if you're interested in that, whoever invited you to the webinar tonight, feel free to reach out to them. We're all on the same team here. Our job is to fill your bucket of questions with as much information as possible. So let's begin. Where are we right now in history? Today is January 18th, 2023, and we find ourselves in maybe the most interesting time in human history for many different things. Geopolitics, spirituality, the family structure, family life, education systems, everything seems to be in disarray. And I don't think anyone will argue with that. It's really a very strange time in history. But I'm here to talk more specifically about economics. And we are seeing things right now in global economics that people have been writing about for 50 years and been wrong for 49 of them that are right now. We're seeing things now that have never been anticipated, and we're seeing it all kind of happen at one time. So let's take a look at the overall picture of economics right now. We'll run through this real quick, but we're going to run through some data that I think every investor out there needs to understand because, again, King Operating, we are an oil and gas company. I am here. I'm not an oil and gas person. I came into this industry voluntarily, kind of seeing what was happening in the global market to hopefully help to build more energy independence in this country, which is where the story begins as to where we are economically. So in January of 2021, when the new administration took office in the White House, the first executive order they signed killed the Keystone XL pipeline. For those, I'm sure everyone's heard the story, but this was an attack on domestic energy independence. As an American oil and gas company, we take great pride in feeding our own. In essence, what we do is we're pulling American energy to be used on American soil. And this attack on the energy sector, specifically the fossil fuels sector, which is a ridiculous term. I can go into that if you'd like as well. But this entire attack began with the Keystone XL pipeline, reducing the amount of oil and gas that flows through the country. This is paramount. Followed in the months to come from the administration were attacks on federal land leasing. So in oil and gas, there are 3 types of land that you can lease. Most property is leased from someone else that drillers use. So you can either drill on private land that's owned by a family or by thousands of people who have a small ownership in the property. You can lease from state-owned land, which is where we stay at, really in the private ownership and state-owned land areas, or you can lease from the federal government and share in revenues with the federal government. Well, the administration, after shutting down the Keystone XL pipeline, they shut down federal land leasing in Alaska, which, by the way, some historical facts. For the past, I'm 45 years old. For most of my life, I've been told that America didn't have any oil. We have no energy. We have to buy it from other nations. Well, recent science, after getting 3D seismic and some of these other seismic technologies that we have available to us, it's become abundantly clear that America is maybe the most resource abundant continent on planet Earth, especially with energy. So when it comes to Alaska, the reason Alaska was an important thing to shut down to try to kill the fossil fuel industry is because Alaska, there's enough oil underneath the surface of the earth in Alaska to power every home, car, airplane, manufacturing plant, all vehicles around the world, all buildings around the world for about 450 years. When you add that together with the Permian Basin in Texas, which accounts for about 41% of the energy on the North American continent, when you add those two together, you have like 600 or 700 years worth of energy underneath the surface of the earth. So our administration decided it would be a great idea to shut down drilling in Alaska. Now, Alaska has a huge pipeline. It's now running at a very thin margin. Then they shut off drilling in federal lands in Utah. Then they went to the Gulf Coast. So off the Gulf Coast, you can no longer use federal land. You can no longer drill on the federal lands that are just outside the Atlantic in the waters, the offshore drilling. So when all this happened, we started creating, and I just want you to use your logical brains here, okay? The media will tell you one thing, but I want your logical brains to think on their own. So after you shut down a huge pipeline and 4 different federal drilling operations, one of them happens to be the largest reserves of oil on our continent, you start creating, a big deficit or a deficit in supply. Now, this correlated pretty directly right after a pandemic where demand was very low, so there wasn't much of an impact. That's kind of the setup of where we are in energy. And I'm going to talk about energy primarily because there's no business that can run without oil and gas. It's not going to happen. And I'll walk through this as we go through. So that created a stir up in the economy. And then we had, the supposed rebound from the COVID pandemic. We've been told there's 1 million new jobs that were created, except for the fact that the head of the Philadelphia Federal Reserve stepped away from his job last month after telling the entire public that there were only about 10,000 new jobs created. So kind of the theme of what I'm going to go through this evening economically is to ask yourself one question: what's true and what's not? Don't let your eyes deceive you. Pay attention to the world around you. It's where you get your best information from. So you could read the newspaper and they can tell you anything that they want to, literally anything. It's up to you to believe it or not, but trust your eyes in the real world. There are more cars on the road right now than I've seen in the last 5 years. People are going back to work and they're driving. And a very low number of those cars on the road are electric vehicles. Nonetheless, let's take a look at the stock market. Where we are in the stock market right now, and if any of you are traders and you're charters, I'm sure that you know this information, but any trader or charter out there or technical analyst, if you take the chart of where we are right now and you compare it to the Great Depression, the initial Black Friday, 1987 and 2008, the charts are identical. So as we approach a time where a dip is inevitable, where our average stock is trading at 100x to earnings, that's very, very expensive for a company. When we're looking at that, I tell people all the time, we deal with investors. I personally speak to about 400 investors a week. And I would say right now, 90 to 95% of those investors are telling me point blank, I've either pulled my money out of the stock market or I'm going to pull my money out of the stock market. Those are just facts. Markets rotate on supply and demand. That is a reduction of demand, which should create a decline in the supply or the price of stocks or the Dow or the S&P or whatever you track. However, we're seeing this massive outflow or liquidation, especially near the end of the year when everyone's selling in order to get tax benefits from a really bad year. Last year was the worst year we've had since 2008 in the stock market. So when we look at these things happening right now, it doesn't make any sense that the stock market's gone up in that period of time. When people are selling out of a market, it should be declining. So that doesn't make sense. What's real, what's not? We can look at the bond market, which is basically centered around the US Treasury. Well, Japan just recently raised their rates from 0.25 to 0.5 point, and they're intending to raise them again. Along with this, they've sold over $1 trillion in US Treasuries. Many writers right now, and you won't find them on the mainstream media, but many market analysts right now are already predicting an illiquid market in US Treasuries in 2023. That's a really bad thing, considering that's the base of our credit source for this nation. Now, as we sit here on January 18th, tomorrow is a very big event in near term vision, market or economic outlook. Tomorrow, Congress meets to determine whether or not to raise the debt ceiling. So after I get through a couple other things, I'm going to explain the debt ceiling and what it may mean to you, especially if you're a real estate investor or if you invest in anything that's tied to interest rates. Tomorrow is a very important day for you to understand. But as we go through this, so we have the normal process of people thinking, where do I invest money? Starts with stocks and bonds. That's just where we all begin. So if the stock market isn't acting the way it should, and last year was the worst year, and people always say, well, it went down, it's going to come up. My personal opinion, I'm not a financial advisor or CPA, I'm going to get that out of the way. But my personal opinion, I'm not touching the stock market next year. I don't think the stock market's going to perform even as well as it did in 2022. That's my personal opinion. You're allowed to have your own, and I compliment you for it. Now, the bond market, we already know, has been tanking for about the last 7 or 8 months. This is where people go when the stock market doesn't work out. It's called flight to quality. They move from the stock market, they go to the bond market. If the bond market doesn't work out, the next level of flight to quality is cash. So let's talk about cash, because cash is very important to understand. Cash will be affected tomorrow. It's affected every day of the year. In every scenario, geopolitically and economically. Cash. Let's talk about cash. Right now, I would say there are 115, 116 of you on here. I would say, statistically speaking, 25 to 30 of you have heard about BRICS. Maybe half. You're accredited investors, so maybe half, maybe more. BRICS stands for Brazil, Russia, India, China, and South Africa. This is a coalition that's bonded together for almost 20 years now, that's been trying to design and create an environment for an alternative to the US dollar as a global reserve currency. For many years, this coalition wasn't looked at with any seriousness whatsoever, but with the emergence of China and Russia having a big stronghold on the energy market, you now have some very worthy opponents to create an alternative currency for international exchange. This BRICS coalition, their central banks of all of these countries have bought over 400 metric tons of gold in the past 3.5, possibly 4 months, so the last quarter or so. They are planning on launching a competitor to the US dollar for international trade, especially for energy, that's backed by gold, silver, platinum, and palladium. There's rumors this has already happened. I haven't seen that, but it's very well publicized. So we now have a competitor for the US dollar. By the way, since we're sitting in an oil and gas office, all oil around the world is purchased in US dollars currently. It's important to note that. So as we have a coalition of essentially a little over the third of the world's population is designing a new payment platform to compete with SWIFT, and they're also creating a currency to compete with the US dollar or Western power, we're starting to get into an environment where the dollar is going to begin to lose value. So moving forward and understanding that there is a competitor, and that's not really a threat yet, but let's look at what's happened over the last 2.5 years. Beginning with the pandemic, even beginning before the pandemic, we've had 2 administrations that have put a little more than 48% of the US dollars in circulation today have been printed since 2019. 48%. That's called quantitative easing, or adding money to the system. During this process, once you've put enough money into the system, inflation occurs. We've all experienced that. If you bought eggs recently, inflation's a real thing. We've had 2 consecutive down quarters of GDP. That traditionally means we're in a recession. They tell us we're not, we are. That's the bottom line. So we had a bunch of money put into the system, and now they're raising rates to pull money out of the system. They're making borrowing money more expensive to lower inflation. I'm sure you all know this. But in the middle of this, we have GDP reports. And this is where historical data and paying attention to the news will help you make better investment choices and hopefully align you with understanding why investing in domestic energy is so important right now. So again, administration comes in, cancels the XL pipeline, shuts down drilling in Alaska, Utah, the Gulf, and off the Atlantic, and parts of Northern California that are fairly robust for oil and gas. That's happened. In the midst of this, we'll fast forward to the 22 midterm elections. So as our supply is depleting, and by the way, the United States uses 18.6 million barrels of oil per day. So as we're depleting this supply, the price of gasoline is going way up in the summer, right? Even in Texas, when I moved to Texas in 2020, a gallon of unleaded gasoline was $1.77. At one point, it was a little over $4 in Texas, where we are literally standing on an ocean of oil and gas, and it was a little over $4. So as this price went up, it starts to create even more inflation. So the government prints more money, more stimulus, didn't work. So what they started doing, they started selling our reserves from our SPR, Strategic Petroleum Reserve. If you're not familiar with what this is, it's a reserve of energy or petroleum that is to be used for emergencies and wartime. That's the only purpose it's supposed to have. They have now drained our SPR by almost 600 million barrels and sold it to places like China. And they've put it into the market cheap to be able to lower the cost at the pump of gasoline. As we approached the midterm election, we started seeing oil prices were well over $100 in the summer, up into near $122. And then they started to come down. As they started to come down, it didn't really make much sense as to why, with the exception of gasoline being cheaper because of the SPR and the sellout from the SPR. But then we started looking at all the different trends and determining how are they determining, demand. They're starting to say, well, if we may enter a recession. Now, traditionally, recessions produce demand destruction. It's a historical thing, but historically, you can throw out the window at this point in time. We've never entered a global recession. We've entered into a United States recession. China's had their recessions. Russia's had their recessions. But for the first time in the history of my life anyway, which is a pretty long time, we are now seeing a global recession. A global recession, to a logical thinker, would denote that demand destruction won't occur. There won't be one country that doesn't use oil. They're all going to still need to fight to regain their economies. So as we're hearing this demand destruction being promoted on the news, we start seeing independent journalists that are coming out and saying they're shutting down the demand data. So the demand data coming from gas pumps that tell you how much gas is used every day, those were shut down before the election. So the demand numbers in this country are sort of unknown. We can make the best estimates, but there's no certainty of proof of what demand actually is at this moment in time. As we move forward into the election, we started seeing that gas prices were going down, but the cost of oil was still up, which we're seeing the inverse of now. Oil's down and gas is dropping. But we started seeing something we've never seen before. After being energy independent for 4 years, the president of the United States went to Saudi Arabia to beg OPEC for oil, to beg him. First things first, he gave him a fist bump. If you know anything about Middle Eastern culture, that's an insult. So the purpose was to go to Saudi Arabia and have them increase production so we could buy their oil to meet our demand. At the same time, the press is telling us that our demand is being reduced. Well, if it's being reduced, why are we going to Saudi Arabia to ask for oil? Now, the outcome of this meeting was disastrous. Not only did they not increase production, OPEC decided to decrease production by 2 million barrels a day. That was directly aligned with Russia, who also decided to reduce their oil production by 2 million barrels a day. Our production, since the new administration has taken office, is down about 1.6 million barrels per day. So if we look at the 3 largest producers out there, we're already 5.6 million barrels per day below what is needed. These are just facts. We move forward. We get through the election. So our president went over there, asked them to increase. They ended up decreasing. And then what we found out from the Saudis is that they actually released an official statement from the palace saying that our president asked the Saudis to delay their reduction in production until after the elections. So if you think that geopolitics has nothing to do with the pricing of commodities, I think that should open your eyes a little bit to see that it has a major impact on commodities, especially energy. Now, as we got through the election, we're starting to see people say, wow, gas is getting cheaper. It went down to, right now it's $2.99 across the street from our office. So although people are telling you the price of gasoline is dropping, I'm telling you, when I moved to Texas in 2020, it was $1.77 and now it's $2.99. That doesn't sound like it dropped any. It certainly dropped from its all-time high, but I think we're about to get back there. Now, during the midterms, we were right in the middle of what's called zero COVID lockdowns in China. Zero COVID lockdown. What that means is that essentially until everyone in a specific province tests negative for COVID, no one can go to work, no one can drive a car, no one can operate a factory. That's still ongoing, but they're starting to create some freedom for them to get back to work because their economy is being punished as well. So when we're looking at all these things happening, this is only taking us to November. We're not getting into modern day here yet. So when we get through to November, we're starting to see China is locked down, but beginning to unlock, which means that 300 million new vehicles will go on the road. At the exact same time, we've seen a drop in production from the 3 largest producers in the world. Correlating directly with this is the fact that right before the election, our government has to produce a GDP report. Before the midterm election and the GDP report, we saw that we had 2 consecutive negative quarters following a 0 quarter. So basically 3 consecutive negative quarters. The definition of the word recession was changed in Wikipedia. Very convenient. But now this GDP report right before the election came out at growth of 2.6%. 2.6%. How did we get there? So if you actually read the GDP report, which I'm boring enough to have done, you will find out that in that report, a bulk of our earnings for the country came from three specific areas that do not impact our economy very much at all. Number one, in October, we had the largest export of liquid natural gas ever in this nation's history. We sold a ton of our liquid natural gas to Europe because right before the election, the two largest gas pipelines that lead from Russia into Europe were blown up. So again, another deficit that was created where we sent American energy over to Europe and they paid us for it. That helped increase the GDP, along with the sale of our SPR reserves to European, especially Chinese. The Chinese were a major proprietor of our oil. And if you remove that, if you remove the sale of liquid natural gas, remove the sale of the SPR to foreign nations, and you remove the fact that we had a huge weapons sale to NATO nations, our economy actually shrank at a rate of 8.7%. So again, you can either be scared of what's happening or prepare for what's happening. But I'm telling you right now, what you're hearing in the news does not correlate with actual reports they're producing. Our economy shrank. It did not grow. It only grew because we sold our energy and weapons to foreign nations. This is the reality of where we sit. So now moving forward, we start seeing a new House of Representatives take hold. We have all kinds of Speaker of the House things, which I actually view as a good thing because someone has to earn a job and not just get it. And we're starting to see a lot of shakeup in Washington, D.C. That's going to lead us right into tomorrow. Tomorrow we have a meeting in the House and with all of Congress to discuss raising the debt ceiling. This is a term that gets thrown around every year all the time, and not many people know what it means. So I'm going to explain it as simply as I possibly can. The debt ceiling is like our credit card limit. Okay, so the way that our economy actually works is you have a Federal Reserve that's not even federal or part of our nation that prints money and lends it to the government. The government then sends it to Pakistan or wherever they send it, and then they tax the heck out of us and repay that debt to the Federal Reserve. That's how our economy works. So our Congress is nothing more than kind of a sales arm for the Federal Reserve. Now the debt ceiling is our limit on that credit card from the Federal Reserve. We're going to reach that limit, which is $31.1 trillion tomorrow. So they're voting on trying to get the Federal Reserve to raise the limit so that they can print more money and send it elsewhere. Because, I think the last stat was like 9 to 10% of the money we've gotten from Congress in the last 2 years has actually gone to America. Nonetheless, big indicators of what this means. Number one, the word on the street from many people in DC and trusted sources that I follow and read for news are saying that the debt ceiling is not going to be approved to be raised tomorrow. I don't know if that's true or not. We'll see what happens tomorrow. But what I want to do is I want to look at everything from a two-prong approach. If it happens and if it doesn't. If it happens, it's a pretty simple scenario. We're going to get a higher credit limit from the Federal Reserve, which they're going to use through bills and irrational spending. They're going to draw down, send to other nations, and raise our taxes. So bottom line is if they do approve it, you can guarantee taxes are going up. Simple enough. If they don't approve it, which it's not likely that they will, they're probably going to use this as a negotiation tool in Washington, D.C. to be able to put more clamping down on excess spending, which I agree with. So if you look at it from and by the way, just to throw this out there, I'm not a financial advisor or a Republican or a Democrat. I am an American and I study the economy. I have no political insight. I am an American. I do not follow either political party, but I do follow good, sound economic advice. And the advice that I would say if I were someone in Congress is to say, don't raise the debt ceiling and use it to negotiate to put restrictions upon foreign spending. That's probably going to happen. In a perfect world or a good democracy, this would happen. But what does the debt ceiling pay for? This is important to understand. So the primary functions of having a high debt ceiling, and what that means is it means that the government can print more money and borrow, which is, by the way, going to increase inflation, okay? And if inflation increases, they're going to continue to raise rates. It's not a good scenario, no matter how you shake it down. But where does this money go? Primarily, most people don't know this. The largest employer on planet Earth is the United States government. The United States government employs more people worldwide than any company or any nation. It's the largest employer. The debt ceiling is trying to be raised for two primary purposes. They'll tell you all kinds of things. We need to raise the debt ceiling to pay for Social Security and Medicare and all that kind of stuff. That's really boiled down. If you're over the age of 35 years, excuse me, if you're under the age of 45 years old, you're not getting Social Security anyway. It's already been spent out. But they'll use that to play on your emotions and say, well, we have to have it for Medicare, we have to have it for Social Security. The bulk of our spending for government budgets goes to government salaries and government pensions. You heard that correctly, pensions for government employees. So the government really wants you to raise the debt ceiling. I don't think the people actually want that to happen, but we'll see what happens. At the end of the day, if they do decide to not raise the debt ceiling moving forward, we're going to see a bunch of things economically we've never seen before. First and foremost, we're going to be looking at government program shutdowns. Now, in my opinion, and this is just my opinion, we have way too many government programs that produce way too little positive results for our country. But we're going to see government shutdowns. We're going to see layoffs or hiring pauses. This is going to bleed into every other facet of our economy. So be prepared for that to happen. We're already starting to see layoffs at Goldman Sachs, Microsoft, Google, YouTube, all over the place. We're going to see a big barrage of layoffs because, quite frankly, what I hope is happening now should have happened in 2008. And I'll get into that in just a moment. So if they don't raise the debt ceiling, we are going to see rates will have to go up, period. The government has debt to pay. If we do not raise the debt ceiling, we are essentially telling the world, as the largest, most profitable, most robust nation in the world, that we can no longer cover our debt. Essentially, that's a horrible economic signal, but it kind of has to happen in order to create a better economy. So again, you can be scared or you can be prepared. Now, moving forward, what does this mean? Well, one thing that's for certain is you're going to see a big turmoil arise in the bond market, the debt market, and especially the equity markets. You're going to see panic ensue because rates will have to go up because more money will have to come back in order to pay the debt. Now, how is this going to affect us on an individual basis? Well, one area that I want to talk about tonight, because again, this is educational, and I will get to why energy makes sense, but I just want to go through the macro environment of where we're sitting today. We have for the first time ever, an opposing competitor to the US dollar who's emerging on the other side of the world. While our dollar is now telling the rest of the world, if we don't raise the debt ceiling, we're telling the rest of the world that our dollar has very little value. It's going to make holding money in cash very dangerous. Here's why. The last time we were in this type of situation economically was 2008. In 2008, we essentially put a Band-Aid on a bullet hole. We had a big gaping economic wound, and we've been putting Band-Aids on a bullet hole since 2008. Now, in 2008, this caused a big shakeup in the banking system. And what happened? We bailed the banks out. Well, when we bail out banks and we pay for pensions and we pay for foreign initiatives, all of that comes back to raising your taxes. My taxes, your taxes, Cole's taxes, everyone's taxes go up. That's how we pay the credit card of the Federal Reserve back. Now, in this scenario we find ourselves in now, there is no possibility of bank bailouts. By the way, banks, they get their money from the Fed. Big banks are essentially a financial arm of the government without anyone knowing that, but that's essentially how they work. So if they don't have the ability to borrow more money, which they won't if we don't raise the debt ceiling, if they don't have the ability to get bailed out, which they don't because of the Dodd-Frank Act that came out in 2008, which bailed out the banks and ended bank bailouts. That's a bailout. That's when money comes from outside the bank to save the banking system. What has to happen next, or could happen next? I don't want to say has to happen, but what could happen next is what the Dodd-Frank Act of 2008 opened the door for, which is called a bail-in. Most people don't know what a bail-in is. It works the exact opposite of a bailout. Instead of getting money from the government, the banks have to get money from somewhere inside. A bail-in provision in the Dodd-Frank Act allows banks to convert their debt on paper into equity. So the way that banks work is pretty simple. I go to them with my money, which is actually a debt instrument of the Federal Reserve, but I go to them and I say, hey, listen, here's my money, hold on to it. It's actually yours on paper until I want it back, and then you have to give it to me, or you have to cover the debit that I created. So technically, on the books of a bank, your money in a bank account is a debt. They owe it to you, if you're following me so far. So when they owe it to you, it becomes a debt. So in a bail-in situation, which would only happen in some sort of economic crisis, and by the way, the head of the UN came out and said the world is heading towards the eye of a Cat 5 hurricane today. So I think we're approaching economic crisis. That would be a logical deduction from the things that we're seeing. But a bail-in program, when you convert debt to equity, you put the burden of saving the bank upon creditors and depositors. And if you don't believe me, read the Dodd-Frank Act of 2008, read all the information you can about bank bail-ins. I'm not saying it's going to happen by any stretch of the imagination, although I do think it's a possibility. It certainly is just that. It's a possibility, something for you as an investor to be prepared for a possibility that could happen. So bail-in, how would that work? If I convert debt to equity on the books of a bank, essentially, I'm going to take the deposits that I owe on and convert them into my own equity. You don't believe me? Please read the Dodd-Frank Act and read about what bail-ins are. This is a strong possibility of something that could come during a financial crisis, which I believe that we are approaching. Now, that makes it very dangerous. So, and to give you some more insight, and if you want to, I'll put together some video packages and links for you to verify everything I'm telling you. But the FDIC had a meeting 2 weeks ago, and a video leaked from the FDIC meeting, and the specific topic at the FDIC was bail-in coverage. So if you have $250,000 in account, you're protected by FDIC insurance. If someone, including the bank, takes that money, it's insured and will be refunded. So at this point in time, and again, I'm just speaking from my own perspective, I will not be keeping over I would not be keeping $250,000 in one account in cash, just to be cautious and safe. And I've been saying this for 2 years. For those of you who are on here who know me, my own investment strategy right now is a 5-pronged approach: gold, physical silver, oil and gas investment, raw land, and some form of crypto. I believe more in Bitcoin than anything else, but that's up to you to determine. So in the midst of that, nowhere do I find holding cash, stocks and bonds, and municipals and government bonds. I don't find that anywhere in that mix because I think we're approaching a very difficult economic period. So we now have, let's rewind our situation. We have a supply deficit of energy around the world, not just here. We have mounting demand and the inevitable increase in demand from 2 specific factors. Number one, China opening up from zero COVID policy will put hundreds of millions of cars back on the road. That will put a strain on the supply that exists today. Number two, refilling the SPR. That has to be done. There has to be about 400 to 500 million barrels of oil that are bought from the free market and put into the SPR. That will also create a spike in demand. And again, these spikes in demand that are inevitable, they're absolutely inevitable. They're going to correlate directly with a massive reduction in supply. Okay, so we're sitting in an environment as an energy investor in an energy company where we're actually sitting in a position where prices certainly will rise. Now, we also have to watch the economics of what happens geopolitically, and in Washington, D.C., we have to pay attention to the bank bail-in system, which was, again, created as a law, the Dodd-Frank Act. I'm going to refer that a million times because no one reads this stuff, and you certainly should be versed on it, which will mean that during this economic time, we're going to look at a couple things that have to happen. More money will have to be printed if they raise the debt ceiling. More money will be printed, increasing inflation. If inflation increases, the Federal Reserve will remain hawkish and continue to raise interest rates. If that happens, you're going to see 7.5%, 8% 30-year fixed mortgages. You're already seeing 6.5%, 7% right now. If we do not raise the debt ceiling and we do not print, we have no ability to print more money and put it into circulation, they're certainly going to raise interest rates. All in the end is going to raise taxes. So the certainties you can bank on in 2023 are higher taxes and higher interest rates. Those are 2 things that I think you can take home to the bank and survive on. On top of this, we have to look at the energy sector itself. We have to understand that energy independence is the purpose of an entire nation. We were energy independent 4 years ago. We were paying $1.50, $1.70, $2 for a gallon of gasoline. But now we have this influx of EV, electric vehicles, electric everything. Here's the truth behind it. They've been investing in green energy for almost a decade. Okay, these are wind turbines, solar panels, electric vehicles. Over $10 trillion over a decade of time, $1 trillion a year goes into green energy. When this began, fossil fuels accounted for 87% of the world's energy production. After $10 trillion and a decade of spending, we are now only at 86%. So if you think that the green energy movement is going to impact fossil fuel usage, demand, and supply, I would wish you well, because the math is not there. It is simply not there. We're 20 years away from green energy being sustainable and powerful enough to power planet Earth. So the electric vehicle myth, I want to break this as well, because you'll have a lot of people who will come into a webinar, listen about oil and gas, and then say, well, I just like green energy better. I'm going to put money into it. Here's some facts. In order to build a battery for a Tesla, it takes 800 barrels of oil, petroleum oil, just to build the battery. In order to get the materials, the minerals, to be able to build the battery, like cobalt and lithium, Number one, you have to create two of the most dangerous and environmentally dangerous mines on Earth. If you've never seen a picture of a lithium mine, I would advise you to do an image search online and find yourself a picture of a lithium mine. They're very dangerous. So you need cobalt and you need lithium. In order to get enough lithium and cobalt to build an electric vehicle battery, you have to move 650 tons of dirt. You don't move 650 tons of dirt with a bulldozer that runs on solar panels. They all run on diesel. Then you take these minerals to a refining factory and then to a manufacturing center, which all run on natural gas or coal. Once an EV is actually built, it's got what's called offsetting emissions. So by the time an EV is built, there have been 13 years of carbon put into the air of a normal operating combustion engine. So there's a big myth that's being broken right now. It's a huge myth. By the way, the average age of a cobalt miner in Africa is 11 years old. So the same people that are out there touting that this is the future are actually exploiting children to create dangerous environments for very expensive products that don't work as well as the ones that exist today. That's just the truth. It doesn't matter if you don't agree. Those are the statistical facts. So if we look at where we are right now, what's going to happen with the price of energy? Well, let's look at what's happening right now in natural gas. And I'll help you draw your own. I'll state my opinion, and there's no way of proving it because I don't work for the federal government. But manipulation occurs, okay? The stock market doesn't make any sense. I explained to you that more people right now are pulling money out of the stock market than ever before, yet it's still going up most of the time. Doesn't make sense. Gold goes up the same days that the stock market goes up, and it goes down the same days. Those should be acting in inverse. The days the stock market loses 400 points, gold should go up, $30, $40 an ounce. It doesn't work that way. They're working in correlation. You're watching a manipulated system short circuit itself. That's what I believe we're watching. And this is evident in the natural gas market, which has very soft prices. Right now, we estimated that natural gas, and most people estimated natural gas at this point in the year would be at about $6 or $7 per MCF per unit. It's right at about $3.50. And I want you to ask yourself a question to see if you get to the same answer that I do. Is during the winter, the coldest months, we've seen the coldest December in Texas in a very long time, and I'm sure your states you've seen the same. How could natural gas be 50% of what it was in the summer during the winter, when 70% of homes in America heat themselves with natural gas? How could natural gas be at $3.50 right now when we just exported the largest amount of liquid natural gas ever in our country's history to Europe? How could Europe even have natural gas without America? You see where I'm going with this? There's a big supply deficit, an extended demand, a higher demand because we're in the winter months, yet the pricing is low. So we expect whatever is happening in that space with the soft prices to burst relatively soon and get back to normal pricing. But that, of course, will cost more to heat your home, to grill out if you have a gas grill, whatever, maybe propane, natural gas, and all sorts will go up in price. It has to happen. It's a natural progress of a market. We're already starting to see a rise in petroleum, but I want you to think of some certain events that happen. These are very important to understand. If you're going to invest in oil and gas, you have to understand that you need to be with a firm that understands how geopolitics interfere or affect or impact the pricing of these commodities. Here's some stats. About maybe a month and a half ago, we had a day where I got to work and oil was down $5 a barrel. That's a big dip. The reasoning behind it was that OPEC announced they were going to increase production by 500,000 barrels of oil a day. 3 hours later, OPEC came out and said, we never told the Wall Street Journal that. They printed that on their own. That's a fallacy. We're not increasing pricing. The price of oil went back up $5 within minutes. Someone made a lot of money on that. Not me, but someone did. So you can see how the influence impacts. The other day, we had the price of oil went up about $2.25, and the only news that actually backed this up or gave it credibility was the fact that OPEC announced that Nigeria was going to increase their oil production by 120,000 barrels a day. That was enough positive momentum to drive the futures market up $2. Okay, if you're following me, great. If you're not, I'll be happy to do. We're gonna try to do these every month, where they're purely educational, macroeconomic breakdown, so you understand where we are as an economic world, and to give yourself enough information to make good decisions moving forward. But if we look at this 120,000 barrels a day, sounds like a lot to a normal person, but I just explained to you that just America uses 18.6 million barrels per day, right? That's like saying I have $18 and you're offering me $1.20. I don't get so excited about that. So looking at in retrospect, it's pretty easy to see how manipulation from news or information can impact it. Now, one assumption we have in the natural gas market is because the prices are so low, a lot of grid feeders or electricity power plants are now looking to get rid of coal and spend their money on natural gas for a cleaner output. Now, natural gas is an interesting story as itself. I can see the prices being manipulated to be low for higher usage. More volume will win the game. But at the same time, the state of Ohio just declared that natural gas is now green energy. This came 6 months after the fact that the EU, right now, if you go to Europe, the EU considers natural gas green energy. So things around our world are changing constantly. The market environment is changing constantly. And one thing that is a constant in the middle of all of this is the fact that you can do nothing economically. You cannot run Microsoft, you cannot run Google without electricity. Electricity primarily comes from coal, oil, and gas. You cannot drive an electric vehicle without powering it up. That comes from coal and natural gas and petroleum. So if we look at what we're being told versus what is real and what is coming, we can see that there's a big difference between what the news tells you and what the reality of situations are. And I don't think many people question that anymore. But specifically relating to our business, to oil and gas, it's abundantly apparent that you should understand that there is no business, there is no world, there is no internet without oil and gas. We are the centerpiece of all businesses in all categories all around the world. There's not one business in the world that can operate without energy. There certainly aren't homes that will live comfortably without energy. So how do you invest in oil and gas? Is it the right time? I think if I did a decent job at explaining factual events that are happening as we speak, and I've got a list that I've glanced at twice, so I think I've covered just about everything on here. But if we look at how the market is, how do you invest in oil and gas? Now, of course, I want you to call whoever invited you tonight and talk to them about King operating, but it's not the only investment in the world. It's not the only way to skin a cat. We think it's the best because we're here, and this is what we do, and this is why we work here. However, there's 4 basic ways to invest in oil and gas. The first and most common is through the stock market, to go out and buy, some of the big oil and gas companies, and you can make profits with them, certainly, and it's a liquid investment. However, we go to energy conferences every quarter. We meet with the big companies. We sell them some of our properties. They come in and sweep up properties from us that we've developed. So we have good relationships with the majors. The majors out there are predicting or promoting a 0 to 5% growth rate over the coming 4 to 5 years, which means that they're in an acquisition mode. They're not looking for new drilling projects. In fact, the CEO of Shell stepped down, and the person who replaced him was the head of sustainable energy. Something is not right with that scenario, but maybe it could be. I don't know. We'll see how it turns out. But I think the timing for an investment in energy makes perfect sense. So how do you do it? You can invest in stocks and bonds, certainly, but you're going to be a victim of normal market influence. But it's certainly a pathway to take. The next way to take is to invest in drilling operations like ours, exploration and production. Companies like us that take raw land that has provable assets and provable reserves. We actually drill the holes in the ground, pull the hydrocarbons out, and sell them to the market. To me, I'm a tangible asset guy in an environment like this. 5 years ago, I was investing in anything with a multiple because it made sense. Today, I'm investing in anything I can touch, feel, and taste and smell, because that's what makes sense in downturns of economies. And I think we're going to see one of the biggest downturns we've ever seen, from even cash being affected for the first time. So you could invest in a drilling operation like ours. I'll explain in the end what that is. Those are generally done through funds. A typical investment in a drilling operation comes with 2 major benefits. You get a tax write-off, so 100% of your contribution into the fund that's drilling wells reduces your income by 100%. A lot of that comes in year 1 and the rest over a 4-year period. And then you receive monthly or quarterly or semi-annual income from the sale of the hydrocarbons. And generally, what you do is you own the hydrocarbons once they're pulled out of the ground. You don't own the land, you don't own the assets. That's what makes King different, is we actually include our assets in the project. But your normal drilling operation will do 1 to 3 wells, not 20, 30 to 100, but do 1 to 3 wells. If one of them doesn't hit, you're probably going to lose your money. But at the same time, they provide tremendous tax benefits and 25 or 30 years of income for depreciating assets. Not necessarily a bad thing. However, we're a 3 to 5 year flip. I'll go through that in a moment. The third way you can invest in oil and gas is through mineral rights. So you could go out and find a mineral right broker. You can invest some money and own a piece of the rights to the land that essentially we work with, right? So a drilling operation, when we come in and say we want this acreage to drill, we have to pay a royalty to the mineral rights owners. So you certainly could invest in oil and gas that way. The fourth way you can invest is through the futures market. You could buy oil and gas on the open market and play the pricing. But as I've explained, unless you're a skilled trader who has tremendous fundamental and technical analysis capabilities, that's a really volatile ride, and one that could be very dangerous for you. But it's certainly an option that you could take on how to profit from energy during this time. But those are the four main simple retail ways to look at these things. So what makes King different? Well, number one, we drill portfolios. We don't work on one small piece of land to wildcat 1 to 3 wells. We build portfolios. So all of our funds are going to have multiple properties, generally in multiple states. Our current fund has properties in the Permian Basin and in Wyoming and the Bighorn Basin. But we actually sit on the same side. We offer an institutional product. So if you were JP Morgan investing in oil and gas, it's the same type of model that we offer to retail investors here at King, where you sit on the same side of the table as the oil and gas company. You own the rights to that land with us. So you'll get a big tax write-off monthly income, which is different. And you'll actually profit from the sale of the leases at the end of the term. In general, the oil and gas company keeps all those profits and your income just ceases or gets bought by a new person. So now I'm going to open up for Q&A. I see a few of them on here. But again, I want to keep this under an hour, so I'm going to keep it right at 6:30. That's 11 minutes from right now. If you have questions about King or the general market, please feel free to reach out to whoever invited you today. They're very skilled and trained. Can walk you through any questions that you have. So right now, we will go into Stu. Hey, Stu. I know Stu. I know Goroff. Eric, where do you see oil at in Q1? Q1's a coin flip. It's already almost a third over. Q1, we're already seeing, over $80 a barrel. I see the big spike in pricing coming with China and with the refill of the SPR. I think those two big stimulus of demand are going to drive prices crazy. If it's done correctly, it should be a gradual increase and not a spike. But I can see Q1. And before I state this, Harrison Kupperman, who's a well-known analyst and trader, he actually thinks oil will be at $200 a barrel in 2023. And Enderon also thinks 140 a barrel. I think that's a good number for the year. Q1, I can see oil at about $92 roughly in Q1, depending on global events that could change. But in general, I don't see the big spike until Q2, which is great for us because we're still buying a third property for our fund. So I actually kind of hope oil and gas prices remain low so we get a better deal and then get to experience the upside that comes from the increase in demand. So good question there. Thank you, Stu. Where do we have here? I thought we had Goroff on here. Dan, in reference to bail-ins, would keeping cash in brokerage companies such as Schwab or et cetera be risky as well? In general, no. First of all, bail-ins have never been done in this country. I have my own opinion on this because number one, it's never been done. So no one really knows how this will operate. But, I'm just going to say this, a bail-in is a communist construct, right? So, and I think we're seeing communism infiltrate America and every country around the world. So there's really no way of telling that, but brokerage companies aren't the same as banks. But you have to be careful. If your brokerage company has a banking arm, it could be at risk. But to be honest with you, I don't know the exact answer to tell you that. My assumption from what I understand on bail-ins is that you'll probably be okay in a Schwab or something like that, as long as it's like FDIC insurance. Again, the FDIC met about this 2 weeks ago. So it's something that's of obvious concern. I hope that answers your question, Dan. Unfortunately, I don't know how it'll work because it's never been done. But I would assume that places like Schwab or where you have investments will be much safer than just a traditional national bank. Travis, what mechanisms are used to manipulate natural gas? It has been natural gas has always been a wild ride up and down. What mechanisms are used to manipulate? If I knew that, I wouldn't be sitting here. Generally, geopolitics do that. You can use institutional purchases to hold off on inventory. Commodities are all the same. I mean, they really are. So like you could look at De Beers, right? De Beers has more diamonds in their vault than exist in the world. So they keep their supply low and demand increases. I imagine natural gas is the same, but part of that manipulation maybe, I don't know, I don't make an accusation of, I can tell you it's being manipulated because it makes no sense that the price is this low based on supply and demand and time in the year. But I don't know the mechanisms, Travis, otherwise I would certainly let you know. I'm asking around for that answer from folks that may know, but I don't know that anyone will know. And there's no way to watch it. We just kind of see things that don't make sense. How are you different from US Energy in Arlington, Texas? From Steve Wood. Thank you, Steve, for asking. I think when it comes to comparing that, I want to be very clear on this. This is a monthly webinar we're trying to run for education on the overall market. I'm not here today to sell you as to why to use King Operating, but I can tell you that we are the only oil and gas operator out there that offers full accountability and transparency and ownership in all of our properties, as opposed to just the hydrocarbons from a well. But again, I don't want to get too much into, selling King Energy. I'm here more to sell information so you can make good decisions. Kent Campbell, what is our minimum investment level? $100,000 is our minimum investment level. And again, not here to sell anything to you, just want to inform you, but 100,000 is our half unit. GPSFU, I don't know who that is, but I like your acronym. Can we reinvest after the fund winds down? You can certainly reinvest. I don't know what winds down means. So in all funds like this, we have a certain target we're going to hit. With this fund, we're going to raise 200, possibly 250 million. Depending on, again, one of the things that's super important to understand about us that differentiates, so we don't use any debt in this fund. We already know interest rates are going to go high and create volatility around the market. So our fund, Program 4, Fund 2 that we're in right now, is completely equity driven. But once the funding is closed for the fund, we actually send out a letter to everyone where no funds come in. So that is certainly something to make sure you get money in while you can. I'll do a pitch for you some later date, but right now I just want to keep everything very educational today. So you certainly can reinvest, but once we've raised our capital for the project, investment is closed. Jeff Haynes, how do you see potential war in Ukraine affecting oil in the short term? Great question. So there's fundamental theories behind oil and gas is that if we go to war, we have to refill the SPR. That creates more demand that'll drive a spike in price. War is actually usually good for energy. Unfortunate to say that, but it usually is really good for energy, for investors. The fact that we already have troops in Ukraine, which isn't very disclosed, we have troops there and we've already sent $100 billion there. I'm pretty sure war is on the table. Energy prices go up during war all the time. Diesel fuel powers all military vehicles, so and jet fuel. So looking at a potential war in Ukraine affecting oil in the short term, prices will go up and demand will obviously go up. But at the same time, you're also going to see supplies get drained. I mean, the economics for the world and energy right now are not good, but the economics for energy companies in this environment are really, really good. And let me put this out there. I do not wish war in this world at all. I am a devout follower of Christ, and I'd like to see peace on earth, but unfortunately, I'm not in charge of that. But at this stage of the game, a war in Ukraine will certainly create a rise in price of energy. Thank you, Charlie. I appreciate the comment. Thank you very much. Can someone visit the company? Joyce Fountain. Absolutely. We actually had somebody in here today. We had 2 people in here yesterday. We absolutely welcome you coming to our offices in Dallas. Meet our team. The drilling guys are all here. The operations team, the growth team, marketing team, accounting, investor relations, we're all here. Very real company, and we absolutely open the doors for anyone interested in investing who wants to come meet the people here in the company. I think it's very important. We can tell you what the horse is and what racetrack it'll run on, but meeting the jockey many times helps people out. Travis, thank you very much, Travis. I appreciate the compliment. I always tell people I run on basic human energy and compliments. So thank you very much. Yes, someone can definitely visit the company. Dale, first name. Oh, sorry, Dale, it's your first name. Sorry about that. Name when King sells at the end of 3 to 4 years. So that's a good question. Again, that's more of a King investment specific question, which I don't want to get into today. But we run 3 to 5 year funds. We have a divestiture schedule to sell to an income buyer about 2 years in to get your principal back. And then at the end of the 5 years, we look to sell at a multiple to one of the majors. So I hope that answers your question, Dale. Next question is from Tara. Does King Operating Corporation have opportunities for non-accredited investors? Unfortunately, at this time, we do not. It is certainly a law that we follow to the T for accredited investors only. We're not in charge of that, so we're not trying to be, snooty or anything like that. It's just we're following the rules. The SEC tells us to operate a fund like ours. We can only work with accredited investors at this time. Hopefully laws change, because I think the accredited investor laws by themselves are created to build up a really wealthy upper class and a really poor lower class. And I think that people on the verge of accreditation should have some ability to do that. Good question though. Jared White, where and how do you like to buy your physical gold and silver? Good question. So I personally buy my gold and silver in person. A lot of people do it online. I don't. I deal with 4 local brokers in the Dallas area. Where and how? I just buy it in cash and then put it into a repository secured environment. So also, could you talk about what happened with previous King Fund that looks like it didn't go as planned? I certainly can at a later date, again, trying to keep this non-King specific, more educational. We did have a fund. We, like any other company, it's been around for 26 years. We've had some hits and some misses. We don't hide from any of them. We've certainly learned from all of them. But I'll be happy to talk about that at a later date, or you can talk about that with one of our senior vice presidents anytime, whoever invited you. But we had a fund that we launched in 2018. Pandemic hit in 2020, and we had some issues with debt that are still being sorted out right now. But we don't hide that. We'll certainly talk about that. Andre Patino, what is the impact of lowering the US SPR? That is a fantastic question. So the immediate impacts of lowering the SPR are that there's cheaper oil in the market that'll create a decline in gasoline prices at the pump. That's the short term. The long-term impacts, I'll give you the math behind it because you should know this. Right now, and we don't know for sure. The government doesn't release here. We don't have a gauge that says we're now at this level. But the government's telling us that we're below 300 million barrels of oil in the SPR right now, which I'm just going to make my assumption that's probably not accurate from this administration. So let's call it 250 million barrels of oil. The math is pretty simple. Divide the 250 million barrels that exist today by 18.6 million barrels of normal daily US operation, and you're going to come out with about 2.5 weeks of oil reserves. That means if we went to war right now, which is a possibility in places like Ukraine, China, and Russia, if we went to war, our military would have 2.5 weeks worth of energy, and then we'd be out. If we had some sort of catastrophic weather event that knocked out national grid or what have you, we'd have about 2.5 weeks of daily normal operational oil available. The government announced it would start refilling this oil reserve, but would it play a role in the price up and down? Also a great question. So the government has announced twice that they intend on refilling. They use the word "we intend on refilling the oil reserve." They have not replenished 1 barrel of oil into that reserve yet, which kind of falls in line because they also told you they'd get rid of student loans, and those haven't gone anywhere. And they told you that all these things that haven't happened. But what they have stated, which I don't believe, but they've stated, is that first they said they intend on refilling the oil reserves at $67 to $72 a barrel. That didn't happen. Now they're saying they want to see an elongated price drop at around $70 a barrel in order to refill the reserve. My estimation, based on factual information and what I see and what they say and what they do, is they don't intend on refilling it. They will have to be forced to refill it by Congress. That's what's going to more than likely play out. Would it play in the role in the price up and down? Great question. Draining the SPR pushes the price of gasoline down. Refilling the SPR puts an increase in demand in the market and puts a strain on supply. So refilling the SPR will actually drive the price back up. Those are great questions, by the way. That's going to win my prize for best question today, or best 3 questions. Estimate when fully funded for, I think, Dale, what you're talking about is the fund. We are right now around 40 million. We launched out basically November 1st. So we raised about $38 million in the first 2 months. We will go to maybe 250. We have some other tack-ons that we are considering before the end of the year. But with a lot of the partnerships we have in place and the momentum we have right now, I think that we will be fully funded in program 4, Fund 2 for King by around June. So we have a lot of momentum going into 2023. So I think we'll be fully funded. By the way, the faster you put money into funds like ours, we have to spend the money to get you a tax write-off, number one. When we do that, we strategically buy out our supply chain so we don't have supply chain issues in the future, which we have now. Everyone has. We also prepay for everything. So the money that comes in the door in January and February is actually buying June and July's piping and lumber and labor. So when we pay for that ahead of time, we help to manage a higher profit margin within the fund. So the earlier, most people will hold off till the end of the year for the tax benefit, but tax benefit is one of three prongs with us, four really, when you include patriotism. But when you're looking at the tax benefit, sure, it makes sense at the end of the year. But at the end of the day, you want to make a profit on your investment. So the earlier we have capital in hand, the more efficient our drilling schedule goes and the more profitable all of our operations become. Good question though, Dale. Last question from Mark. How often are new investment opportunities becoming available through King Operating? 2 or 3 year opportunities per year. Well, in general, so to clarify that, our funds are designed for a 5-year period. About 2 years in, we look to get your principal returned to you through a divestiture. And at the end of 5 years, full exit and profits sent back. We also pay monthly, so you don't have to wait an extended amount of time to start receiving your money back. We pay monthly once we're at revenue. We anticipate we start drilling next week for this fund, by the way. So we're really excited here right now. Great property in Borden County, Texas. But when we start drilling on that, we'll actually we have a 2-month lag. So we start drilling end of January. It's going to take us about 36 days to complete a well, another few weeks to create a flow back so that we can really start moving into the profit. And then there's a 2-month hold of the cash while we do the sale of the hydrocarbons. So we're looking at April, possibly May, for checks to start arriving into your hands. But we are really, the properties we have, we are really, really excited. And this is a one in a series of 8. So our goal as a company is to reach 10 billion in valuation of total assets by the year 2030. So we'll have this fund, we'll have another 1031 fund available for real estate capital to go in there. And then we have another series of 5 funds. So we are really building out a robust portfolio of wells all across the country. So there's always an investment opportunity here. I think in 2022, we had about a 6-week window where we didn't have an offering for investors. And that may occur, but it's usually about a 4 to 6 week. Once we know we're going to close out the funding on one fund, we generally start buying properties for another one. So there's generally an investment opportunity here. Good question, Mark. Last question come from Michael Wade. Can you tell us more about current interest rates, debt financing, and market considerations? What is King's strategy? Great, it'll be our last question. I've got to go here tonight too. Current interest rates. So right now we're looking at I think this is now 7 consecutive raises by the Fed. They keep saying they're not going to stop, yet the market tells you the Fed's going to pivot any minute. The Fed's not going to stop raising rates, especially with the debt ceiling. So we're going to see a continued high stress interest rate environment, which means that real estate investments will get difficult. You're already starting to see real estate investments there. They have adjustable rates. Where investors were getting checks 2 months ago, they're not getting checks now because the profits are being used to pay back the loan as the rate adjusts. It's very common in the market. You're going to start seeing a lot of that stuff happening. Debt financing, we've done debt financing in our past funds. However, this fund is designed with 0 debt. So this is a 0 leverage fund. If we need more capital in the future, because inflation and supply chain does put a strain on financing, it's difficult to project proper financing. If we need capital in the future for this fund, we will raise it. The current interest rate environment for oil and gas is bad. Not that the rates are bad, it's just the fact that JP Morgan, Chase, Bank of America, they're not lending to oil and gas. There's a gigantic governmental push to kill the actual energy that works on planet Earth. So we've actually just said we don't even want to deal with it. We're going to raise all equity. So we really want to be a 0 leverage, 0 debt fund available in a market where leverage, debt, and interest rates are going to put a hurt on a lot of investments out there. And market considerations. That's something, our strategy at King for this fund and funds moving forward is to raise all of our capital needed on equity. Dependence upon bank. Why would we depend on banks? Banks may be bailing in very soon. That's a possibility. I'm not saying it's going to happen, but it's a possibility. So depending on financing for success of any operation, whether it's real estate, note selling, whatever the investment that's available, a lot of alternative investments are dependent upon financing or debt to be able to leverage cash. We're completely out of that. So we are focused 100% on equity, and we'll drill as we go, as we raise. So we're really looking at, what makes things simple. Our strategy is very simple. We are one of the only businesses in this country that actually makes our own product. We create things, we sell things. Most business, even Microsoft didn't sell me this computer I'm using. It was made in China. They sold it to me, but they didn't make it. We actually make and sell our product in America from America. And we are dependent upon the American people to be able to fund that for tax advantages and for monthly income. Our investment fits right into where people need to be right now. I can guarantee you taxes are going to go up. So you need to find an investment that'll lower your taxable income. I can guarantee you that regardless of what the government tells you, inflation, true inflation of what you pay for things, that's going up right now by about 18%, not 6.7 like they're telling us. So monthly income will help offset the inflation that you have. And then of course, everyone wants to make a multiple in their capital. So our investment strategy dealing with leverage is to avoid leverage at all costs right now, to go into a full equity play, zero debt financing, raise your money, pay for your stuff on your own, very old fashioned model, but one that we think will be very successful. But great question, Michael. And I'm going to wrap up on where we are right now. We're a little over an hour, 8 minutes over the hour right now, actually about 5 because we started at 6:33. Thank you all so much for coming tonight. I hope that you learned something. I hope you have something. One final question. The building back here, well, that's where Jay's book was in Times Square in New York. And then these are all derricks from around the country. That's the building in the background. Thank you so much for your time tonight, guys. I hope you learned something. Please give us feedback. We're going to try to do these every month. What we'd like to do in the future is to just, you've got the folks who invited you tonight. Just send them questions that you have. They'll send them to me. So next month I can design a presentation that'll answer the questions you have. It doesn't matter what market it is. I could care less if it's about oil and gas or foreign derivatives or whatever it may be. Ask us questions. We want to be able to provide information to you. Our investors that we work with right now are amazing people. We love you all. And if we can help educate you, it only makes all of us better. So for each and every one of you, thank you so much for coming tonight. God bless you all and your families. I hope you have a wonderful evening. And if you're interested in investing in King Operating, feel free to reach out to one of our senior vice presidents and they'll walk you through everything one-on-one. Thank you, everyone, and have a great night.